Shareholders of Shell have agreed to the company's new watered-down emissions goals. The oil major will lower its targets for reducing carbon intensity by 2030 from a firm 20% of 2016 levels to between 15 and 20%. Shareholders again rejected a resolution calling for the company to pin its strategy to the Paris climate goals. Shell's board says it'll continue to focus on oil and natural gas projects but commit to carbon neutrality by 2050. Stephen Beardsley from our business desk is following these talks. Let's start with the new climate targets. Why is Shell weakening them in the short term?
Because oil and gas production are so profitable, Ben. That's why. And this is a company that's been very clear that it wants to maximize shareholder value, that is going to be its number one overriding purpose. It believes that it can do that in the near term up to 2030 while this demand is still high. It says that it sees demand for what it calls low carbon products. For example, natural gas, liquefied natural gas in particular, which it believes will replace more and more coal around the world. Aviation fuels that release fewer emissions, biofuels, for example, renewable diesels. These are just some examples. It also wants to continue with its oil production at its current levels through 2030, seeing that there's a market there. It doesn't want to divest. Again, this is a company that's been very emphatic. Shareholder value is going to be its focus. It has turned away from some parts of the company that are lower profit, including lower carbon alternatives, including its focus on renewables. Now, that has garnered a lot of criticism from outside the company and also from inside the company. So it's been a bit controversial, but there's really been no secrets that this is what it's trying to do. So it really is saying in the short term, there is still a case for these kind of products that it's going to provide.
But there are still some shareholders who are worried about the environment.
Yeah, for sure. And they showed that. You saw that with a resolution that failed that you mentioned. It still garnered almost 20% of votes. That's almost 1 out of 5. That's not bad at all. And that's more than we've seen with other shareholder groups for oil majors. So there is something to be said for that. We know that, this is something that all oil majors are seeing right now, as there is this kind of drive by shareholders to push for more renewables, to push for more action, but it's very hard to define exactly what those goals are. And so Shell certainly isn't alone.
Would you say, though, that the company and its shareholders are worried about the environment in general?
For sure. If you're seeing 1 out of 5 shareholders, that's not nothing. But again, the ultimate tension here is that you have a major business that has a business model that can be lucrative if it focuses on something that ultimately should be phased out over time. Shell can say that it's not going to hand over lucrative parts of its business to its competition as long as they're all playing by the same rules. Demand has to be taken care of on a broader level. And that's exactly what they said in very frank terms, that we're not going to hand over these parts until demand changes. As long as demand is there, we're going to abide by that. There's been a lot of pressure on institutional investors, such as the BlackRocks, such as the Norwegian Sovereign Investment Fund, to actually be the ones who follow these resolutions, who support them. But that hasn't happened so far. They've also said, look, we believe in the shareholder value the company's created and that they're following this path to 2050. But there remains this big question, how exactly are they getting there if they've watered down some of the language, if they've watered down their targets? They've taken away a 2035 target, which means that between 2030 and 2050, there's a big question mark. So that's something they're going to have to answer in the near term.
Stephen Beardsley, thank you very much for coming in.